Well, good morning, everyone. Welcome to the webinar, our third of a three-part series of community immunity. Today, though, we are talking with Scott Underwood from the Indiana Small Business Development Center. We really appreciate having him with us this morning, and I will be turning this meeting over to him in a brief moment. I just want to give you one word. We have the webinar coming up called Not So Fast. It's on April 28th. We're working in conjunction with the EDC on this, and it's to help us business people to think about how we ought to be opened and prepared for that when that time comes. They will have two health experts and then two people from HR as well experience who will be the main panelists, and it'll be a kind of Q&A format. So hopefully you'll be want more information, you go to the EDC website, growinhenry.thinknet. So anyways, if you want more information on that, feel free to email me or give me a call, and I can walk you through that. In the meantime, though, if you have questions for Scott, please send them to me. You can send them to me through the chat. There's a little bubble that looks like a cartoon speak kind of a thing down on the bottom of the screen. You can click on that chat thing, and that will pop up, and you will be able to send me questions. Feel free to send me questions throughout the whole entire presentation. I will give those questions over to Scott so he can answer them for us. Time though, please mute your microphones so we don't have any background noise, and then we will go forward from there. So, Scott, take it away.
Thanks, Sean, for having me this morning. I'm excited to be here, and I'm excited to share with small business owners who are interested in figuring out how do we survive this. I'd like to call it anything other than a mess, but it's a mess. And so how do we get to the other side of this and survive and then thrive on the other side of this? So we do this, don't be afraid of your numbers, AKA 5 numbers you need to know on a regular basis during this time. This one is actually a little bit special because this time it is the COVID-19 edition. So please refrain from clapping and shouting at your desk. Before we get into this, I would like to, I told Sean I'd take some questions, but then I realized how hard it would be to take questions about some of the SBA stuff. So I thought I would address that before we really got into this. Many of you know that the ISBDC is a division of the SBA. So we are not the same. We don't have access to their same kind of information, but we are cousin, if you will, just like SCORE is. And so the SBA normally plays 2 roles in our economy. One is they underwrite loans at banks during normal times, and the second one is they have us as boots on the ground in the communities to help people in their businesses. And right now, because we're in a disaster time, the SBA is doing direct lending, and so that's what you hear on when they're talking to every day on TV. They're talking about the SBA doing direct lending. That's for disaster times only. Normally, those disaster times are when Newcastle gets hit by a tornado and they have 15 people reaching out to them for help, or 100 people reaching out for them to help. And in this situation, unfortunately, the United States got hit by a tornado, and so they're getting unprecedented requests. I read somewhere that they handled 60,000 loan requests last year. In 1 week of this, they got 500,000. So I know everyone is frustrated if you haven't gotten your PPP or your EIDL yet, but I think in their defense, they're just overwhelmed with volume. And so, so speaking of the EIDL and the PPP and some of that, many people are calling me and saying, I put my EIDL application in, that's the loan/grant forgivable loan that you filled out online. They gave you a confirmation number, and you're waiting. And they said, hey, you'll get a $10,000 grant in 3 days. Was what they said early on, which was a huge mistake to ever say that, because actually what it ended up being is not 3 days. And for many people, they went back and they said, if you get anything, it's going to be not $10,000. It's going to be $1,000 times the number of employees you had on, I think it was January the 15th, or the end of the year, or something like that. So I've only had one of my clients get their grant. I've heard secondhand from a couple other people. So if you're waiting, it might not be that they missed you. It might be that you're still just waiting. And I'm hoping this next round of funding, I'm not sure if it's going to the PPP or going to the EIDL, but we're hoping some of that money will fill out some of the people that are still waiting. The PPP, as you know, for anyone that's filled that out, it goes through the banks, and the bank would be your contact on that. And I think that ran out as well, and I'm sure that this new round of funding is going to fill that pot back up again. I just don't know how many people are lined up in that pot and where your application might be in the process. So if you're third on the line, you're going to probably get the money. If you are 500,000th in the line, I don't know. And so from the very first day of this stuff, we told everybody, apply for everything that you can, and then pretend or operate your business like it's not coming, and make changes and make decisions that you have to make, assuming that the money is not coming. And then if it does come, you'll get a benefit from there. Somebody asked me a question about, can you use, if you were fortunate enough to get the EIDL and the PPP, can you use them both? And there's been mixed messaging about that. One says that they're going to subtract your EIDL from your PPP. Another said that you can use them both. You just can't use them for the same thing, i.e., payroll. Sean, I'm going to take a breath for a minute. Are there any questions, or should I go on?
No questions have entered just yet, but we've had a few people come on in. So, but nonetheless, we'll go ahead and continue, and I'll inform everyone if they can send it to me. So,
okay. Other questions have been, will we have to pay it back, and what's the process, and who's going to determine, and how we have to report it? And none of that, as far as I know, has been determined. Somebody said, is it going to be taxable? The question's out there, is it going to be taxable? And they're still arguing, I think, about that as well, to see if it's going to be taxable or not. If it is taxable, then it's less of a grant and less helpful. If it's not taxable, that's a huge drain on the federal tax base. So I think they're still working out details, as well as I saw some recommendations yesterday about how the PPP might have missed the mark. And we're going to talk about that a little bit later in terms of how it impacts your business. I'm going to move away from the SBA stuff and move towards the presentation, unless, Sean, you have a question for me.
continue onward, sir.
Thank you. Okay. We're confirming that everybody can hear us, and I'm just not doing it for you and me, right?
Yes. Yeah.
Yes.
Everyone that's on can hear you, sir.
All right. Not that it's not enough just to do it for you and me, but it'd probably be more beneficial if other people could hear it as well. All right. So why this talk, and why now? We've always talked about this being important for the reasons that you see below: to manage your business, to get a loan for an equipment or a building, or to sell your business. And so we've always done the 5 numbers you need to know, because it's just, I don't know how you can run a business without having it. And so now, as people have figured out, it's really important, and when the COVID-19 is to get COVID-related assistance and to make COVID-related decisions. And so what that means is, I talked to someone earlier in the week, and she got a PPP loan, and she felt like it was because she had clean financials. They showed profit. She got it in right immediately. She didn't have to mess around with trying to put it all together. And she felt like that was a real benefit to getting her PPP. I know I've talked to people this week that have said, hey, I finally got my act together, got my information together. Where do I turn it in? And the EIDL has been closed for about a week, and the PPP has run out of money, and they're out of that system. So I don't know. We can ask the bankers on here if they're taking more PPP applications. I don't know the answer to that. But I think the point was, in a first come, first serve environment, the money went to people who had their financials ready and clean and ready to give to the bank, and ready to move forward. If we look then, so that's why this is important anytime, and this is why it's important now. Why it's even more important now, I'm going to start out with a personal story. Maybe. This is the financials. Part of my job is I think about this kind of stuff, which is weird and sad, but still the case. This is a personal story of our trip to Johnny Carino's in Muncie. Now, we have been honoring our Henry County businesses and eating at Henry County businesses, but we do like Johnny Carino's in Muncie, and we did do this recently. Um, we go there when the family platters are half price, because otherwise it's expensive. My two daughters just moved home from college and they brought home a friend, and I can't afford to pay for all that. So we wait till they have their family platters on half price. But at the same time, the offer was family platters half price and 2 orders of free cheesecake. And so you think, okay, well, we can actually somewhat afford that. But my question is, can they afford to sell that to us? And so I sat down and kind of did the numbers on this yesterday. And I think this is the point of the story for business owners, is to find out, can I afford to do this kind of deal, or what kind of deal can I afford to do, or what do I have to sell at the margins, or all those kinds of questions. In this particular situation, if you look, the normal order would have been $74. They sold it to us for $32.50. I estimated their cost of goods sold to be $22.39, and we estimate that they made $10 on our order. Now, $10 on our order is not as much as it could have been, but if you get enough $10 orders over enough days, you might be able to pay your expenses and keep open, or do whatever you need to do, or mitigate your losses depending on what it is. But that's assuming that they had a 30% cost of goods sold, and then they knew that. If you look at the two bottom lines, if they had a 40% cost of goods sold on their food, instead of making $10, they made $2.72. That's a different conversation. And if their cost of goods happen to be 50%, they lost $5, $4.73. And so every time we ordered from them, they lost $5. And so you do not make up for that with volume. And so the question really is, how do you have this kind of conversation about your business? I know that everybody's Johnny Carino's. John Manter has to figure out whether how much to charge for his services, and can he give discounts, and should he run specials, and HVAC companies and plumbing companies, and everybody else has to figure out their version of this conversation for the business. But this is where it starts at this level. Should I run a special? Can I afford to run a special? What might that special look like? Do I know what's going to happen when I run that special? Moving on. Sean, questions? Good? Good. So the good news is, during these crazy COVID times, is that it's still simple business math. People come into my office and they say, I want to go take a business class, or I need to get an accounting degree or something like that so I can understand my business. And the point is, you really don't. I'm not against education. I'm not against those classes, but it really is not that complicated if you know what you're looking for and know where to look. So we say that the basics of small business, or about business accounting in general, is it's all the same, roughly. All businesses, big and small, have essentially the same profit and loss. There's more complexity in their numbers. The numbers have more zeros. They may have more categories, but it's all essentially the same. So if you're sitting out there saying, this kind of talk doesn't apply to my business because I'm a pharmacy, or I'm a home health care business, or I do lawn care, or I do whatever, I would say it does apply. It's all the same. Apple, Subway, GM, McDonald's, everybody has, and Stacks and Los Amigos, and everybody has essentially the same income statement and the same categories. We want you to look at 5 numbers: revenue or sales, cost of goods sold, gross profit or gross margins, 2 different conversations we'll have in a minute, expenses, and net profit. So revenue is just simply your sales, what people pay you to do what you do, before you take out any expenses, before you take out any of your costs, anything like that. It's just literally, I charge somebody $89.99 for a service call. That's my revenue for that particular call. We sold $300,000 worth of breakfast this year. That was our revenue for that. Contrary to popular belief, it's not what I made last year. So if I talk to a client and they say, hey, I said, how'd you do last year? They said, I made $150,000. I think, wow, that's awesome. That's your profit? They said, no, that's what my sales were. Okay, so revenue is not what you made, it's what you sold. It's usually good if it's increasing, but not always. We'll have this conversation later about checking out your margins and your cash flow. You can do some really bad things to your cash flow if you sell, and you don't have the ability to support those sales, buy more materials. I was in a business once where something big hit and we were selling a year's worth of product every month. And we did that for a couple of months. We ran out of money. We couldn't buy materials. We couldn't pay our people. It was a big hot mess. It can be broken down into product mix, and we're going to talk about that here in a minute. McDonald's product mix is hamburgers, fries, drinks, and shakes. John Manter's is carpet cleaning and fire restoration and water damage restoration and mold remediation and those kinds of things. I'm not picking on John. I just happened to see his name in the list there. If anybody else wants to jump in and have me do their business, I'll be happy to do that as well. And lastly, it's sometimes called top line revenue. Top line revenue, sales revenue, all that the same information. So product mix, why is product mix important? It's important to know where your revenue is going to be coming from. I'm supposed to get 20% from this product and 30% from this product, or 45% from this service and 12% from this service, or 35% from breakfast and 25% from entrees, or things of that nature. So that takes this big giant pile of revenue, whether your pile is $50,000, $250,000, $1 million, or $5 million, and it breaks it down into smaller segments so that you know, hey, our sales are off this month. Where are we off? Well, we're good on breakfast and we're good on lunch, but our dinner is off. Or we're good on appetizers and we're good on entrees, but we're not selling enough drinks, or whatever that is. So you begin to understand where to look when things are either going poorly or when they're going well. And you can go look and say, hey, this category is doing really well. Our white widgets are doing really well. Why is that? Well, because they're priced better than our red widgets, or whatever that is. It's also important because you know what you want to sell and why. It doesn't make sense to advertise your lowest margin product that's the hardest for you to make and that you hate the most when you want to do that. So what you want to do is know what I want to sell. I want to sell the highest margin stuff that everybody wants and is the easiest for me to make. And I got to know how much of that has to be coming from each category. And lastly, it helps you drive what marketing decisions that you're going to make and resource allocation. So if I'm McDonald's and I really don't care about selling burgers, but I want to sell frou-frou coffee drinks, you're going to see advertisement on TV about coffee drinks more than you are about things that I really sell because I have to and not because I want to. Taking a breath, Sean. Questions?
There was one question. One was asked if they could have a copy of the slides sent to them. Is that a possibility?
100%.
Excellent. And then you did get a thank you from John for the mention.
Shout out to John. All right, sounds good. All right, so we just did revenue or sales. Now we're going to do cost of goods sold. This is the single area that is most poorly done, least known, most ignored in all of our clients and all of their profit and loss income statements. This is the category that is missed the most, and it is the one that I think is borderline most important. Basically, all the cost of goods sold is the ingredients in your sandwich, the parts in your car, the guts in your phone. If you're a service business and you're selling somebody for $89 an hour to go to do an HVAC job, it's what you paid for the man and the gas and the materials and whatever to do that $89 job. That cost of goods sold helps you understand what do I have in this for what I'm selling, and basically what you have in that, meaning your ingredients, your direct labor, your direct components, your inputs, whatever you want to call it. That's not even your money yet. That's somebody else's money. So if somebody gives you $100 to do a sales call, and you got to turn around and give Joe $25, put $10 of gas in his car, that's $35, and then he has $10 worth of material. That's $45. That first $45 of that $100 is really not even your money. You can't use it to pay your bills. You can't do anything with it. You certainly can't take it home. That is somebody else's money. And so to understand how much you have in your cost of goods sold, is so important when you price, when you project, when you somebody comes in and makes you a really good offer on something that's cheaper than you normally do. Hey, well, I'll give you all this business if you'll take 25% off your sale. That's when it's really important to know what you have in it. This harkens back to our Johnny Carino's conversation about what do they have in the food cost of that order that they sent me. So cost of goods sold is what you pay your vendors or your suppliers. It usually is raw materials, but it can also include labor depending on how you do your business and the accounting system that you use in your industry. It's usually expressed as a dollar, as a percentage and a dollar amount. And the reason that is because if you're looking at it historically, you know what that number was. You know that we had $200,000 in sales and we had $100,000 in cost of goods sold. So historically, you know what that number is. When you're going to turn around and try to project into the future, you need to know what that percentage is going to be so that you know next year when we do $400,000 in sales, we'll have $200,000 that is cost of goods sold and will be off the table for me to use in the future. So it's the same. Essentially, it's the same. Two different ways looking at the same number, and it can vary with product line or service. So back to McDonald's, they may make killer money on their drinks. They may make okay money on their fries. They may lose money on their sandwiches. So it's nice to know on each one what is the cost of goods sold so that they can understand. If somebody buys a Happy Meal, I do, or a value meal, I do great on the Cokes. I do okay on the fries. I don't do so hot on the hamburger, but when they put it all together, I do okay on the whole order, and that's the number that I can use going forward. It adds the cost of goods sold, the percentage adds together with the gross margin to be equal 100%. And all that basically means is they're two sides of the same coin. If your cost of goods sold is 50%, your gross margin is 50%. If it's 40%, then it's 60%. If it's 60%, it's 40%. And we'll get to this in a minute. But basically, cost of goods sold is one side of the coin. Gross margin is the other side of the coin. And so how you know if something is cost of goods sold is if it tracks up and down with your sales volume, then it's generally cost of goods sold. So if I build more houses, I have more labor. If GM builds more cars, they have more parts. If Apple builds more iPhones, they have more guts. If the iPhone market tanks, they have fewer guts. And so basically it tracks up and down with your volume. If it stays the same, insurance stays the same, cell phone bills stay the same, rent stays the same, then it's not cost of goods sold. It's an expense, and we'll get to those here in a minute. So if it goes up and down with volume, it's usually cost of goods sold. Okay. So why is it so important now? If you've been shut down and you're trying to ramp up, you got to know what you have in, what you're doing to know what kind of money you're going to have left to pay your bills. If you're considering sales discounts or coupons or whatever, you have to understand your costs. Back to our Johnny Carino example, you have to understand your costs to know how much money you're making, how much money you need to make it worthwhile. And then how do you avoid, so just so you can avoid spinning your wheels and wasting time on resources, if you turn around and you sell a bunch of, if you sell a bunch of one product, one widget, and you don't make any money on it, but all your inventory is tied up in that widget, and all your time is tied up in that widget, no matter if you sell 1 million widgets or 2 million widgets, if you're not making any money, you still end up with zero, and you can't sell other stuff that you actually do make some money on. Okay, Sean, good?
Yep, we're good.
Okay. So if you go back to so that we've done 2 of our 5 numbers you need to know. We did revenue and we did cost of goods sold. So now we're going to do gross profit. Gross profit is, like I said earlier, what's left over after you pay your vendors and suppliers. So it's after you've given your money to the people that either sold you products or did the work on your stuff, or provided the service that you provide. I guess I want to say I focus more on products, but it's exactly the same for service. If I'm Bethany Cares and I'm charging $22 an hour and I'm paying $12 an hour, 22 is my revenue, 12 is my cost of goods sold. If I am, I don't know what else. If I'm a dentist, I don't know. I'm gonna skip that because I can't do dentist. So basically, don't check out if you're a service company. It's not any different for you as a service company. It's what you have left over to pay your administrative expenses and pay yourself, hopefully. It's usually expressed as a percentage and a dollar amount. That's the same conversation about being the other side of the coin from cost of goods sold, and they add together to equal 100%. So why is gross profit so important right now? Gross profit is the top number that you have to have enough of to pay the bottom number. And I'll show you that in a minute. It's what you have left over after you sell and pay your people. It's what you have to have there to pay off the rest of your expenses. And I said earlier, cost of goods sold is I think the most important number. Gross profit is right behind it, because that is, if there's not enough money in the gross profit, there's not enough money to pay your expenses. And so no matter how much you squeeze your expenses, if your pie is not big enough in the gross profit, you can't get to where you want to get to. So it dictates the kind of expenses you can support, or is dictated by the amount of expenses you already have. If you already know that you have $5,000 in expenses in a month and you can't get out of that, then you have to at least have $5,000 of gross profit to break even. I'll show you more of this in table form later. So here's kind of a really simple example about gross profit. In a perfect world, you sell $500,000. Your cost of goods sold is $250,000. So you have $250,000 in gross profit to pay $150,000 in expenses, and you have $100,000 in net profit, and life is good. Then all of a sudden, your sales slow down, but you maintain your margin, so you have $200,000 still of gross profit. Your expenses didn't change, and so you have less net profit because you didn't have as much gross profit to start with. If we go over to not enough margin, now I sold a lot, but I did that by couponing and BOGOing and cutting my prices, or I didn't adjust my prices when my costs went up. And so I was still really busy. I had less gross profit to show for it. My expenses stayed the same, and I ended up with nothing. So this is the worked really hard, went really broke scenario. And then this one is too many expenses, where my sales were good, my margin was good, I had good gross profit, but my expenses I hired my son because he couldn't get a job anywhere else, or another family member, and I really didn't need him, and so my expenses went up and my net profit went down. This is a simple overview. We'll get to it more in detail later, but essentially this is the gross profit. If you pay attention to the gross profit number, it is what you had left over to pay your bills. And when it was enough, we did well. And when it wasn't enough, we didn't do so hot. Okay. On to expenses.
Hey, Scott.
Yes.
I do have one question, if I may.
Go back.
No. What the question was is labor a COGS or an expense?
Great question. And it's so, if we think about labor in terms of direct labor or indirect labor, that probably helps answer that question. And if it's direct, if you're making something and it's directly involved in what you're making, then I would call it direct labor. If it's a so you go, well, I'm Subway, so they're directly involved in making my sandwiches, but they're standing there whether somebody comes in or not. And so I would classify that person as just general labor or indirect labor, because your labor costs don't go up and down significantly with volume. Now, obviously, if you went from doing $500,000 in revenue to $1 million, you'd have to hire more people. And so the case could be made there that you wanted to put some kind of figure in that. But someone standing behind a counter who's going to be there, whether you're busy or not, is regular labor, and that would be an expense. So the test really is, does it go up and down with volume? And if it goes up and down with volume and it's involved directly in making the product or providing the service that you do, then that would be direct labor. So for John being the president and king of ServPro, he's probably not direct labor. He's administrative. Diana is salesperson, goes out and does estimating. She's probably an expense. I don't think she does a lot of hands-on stuff. So she would be an expense. She would a labor of expense. But Ray and all those other people out there that are doing the work, putting their hands on stuff, providing the services that they provide, that would be they would be direct labor. and you need to account for that, because if you got 10 more kitchen fire jobs, you'd have to hire more people.
So if I understand you correctly, Scott, if they're direct labor, they go to the cost of the goods category.
Correct. And even if your accountant doesn't want to put them in that category, you have to know what that number is so that you can begin to project profitability on the work that you're doing and predict the future.
Okay. Thank you.
Good.
Thank you, Scott. We're good. Thank you.
Okay. So we'll go on to expenses. So expenses are everything that comes out of your business that really is not cost of goods sold. So it's advertising and administrative payroll and taxes and insurance, utilities, and then some other stuff that you don't have any effect on, like interest and amortization and depreciation. And basically, if you think about cost of goods running up and down, with your volume, this line stays pretty much straight and steady. It doesn't vary a whole lot. So somebody would say, well, if I'm really busy, my electricity would go up a little bit or whatever. That might be true. And if it's significant, you may want to go ahead and try to capture part of that with your cost of goods sold. If it's not significant, then it's probably okay to leave it down below in your expenses. And down below and up above, we'll talk about when I show you some examples. Let's see what you above the line and below the line. I'll show you that in a minute. So at the end, if we've done it properly, we should have some kind of net profit. And then if your accountant will then want to make it disappear with some kind of accounting magic, depreciation, amortization, whatever, and then you'll pay taxes on that. It's important to show a profit if you're going to try to go to the bank and buy a building or buy a new piece of equipment, or if somebody wants to come and buy your business. If somebody wants to buy your business and they're going to want to make an offer of what they're going to do is they're going to say, okay, your assets are worth $100,000, and then they're going to want to pay you some multiple of what your profit is. And so they're going to want to pay 1 times your profit. You're going to want them to pay 4 times your profit, and then you'll end up somewhere in the middle. So if your profit is 0, whether you do 1 time or 4 times, it's still 0, and you're an asset sale. So if somebody is, Sean, tell me who else is in else on the line, so another business, so I can give them a shout out and leave John out of it. Who else is on here?
Well, we have Doug from State Farm and Action
Staffing.
McCoy and Jessica are here.
Okay, so that's fine. Thank you. So if the Coys are going to sell the staffing company and they say our business is worth whatever it's going to be worth, their assets are probably pretty small, desks and computers and that kind of stuff, but they're going to say we made $100,000 last year. I don't know what they made, so don't quote me on this. We made $100,000 last year. We want you to pay us $400,000, 4 times 100, to buy our staffing company, and I want to buy it for 1 times 100 and give them $100,000. If you're not showing profit, or if it's not clear what that number is, then that business is worth essentially what you can convince someone that it's worth, or what they're willing to pay, because you're not going to be able to go to the bank with bad financials or showing no profit. So too many people in my office come in and they want to show no profit. Their number one conversation is about avoiding paying taxes. And so they're trying to write off everything and hide everything. And the problem with that is you can't sell that business to anybody else without having profit, or it's just going to be an asset sale. Okay. So let me just give you some normal examples of how this is supposed to work. In a golden year, you had $100,000 come in of revenue or sales. You had $50,000 of cost of goods sold, which left you $50,000, and you paid some expenses, and you had $25,000. Now, if your numbers are, if your numbers are $1 million or 500,000 or whatever it is, 25,000, the numbers, the process stays the same and it scales up and down. Okay. So after the golden year, someone sees how golden you've had, and they come in as a competition. And so they cut your sales from 100 to 80, but you do a good job and you don't cut your margins. And so you actually still make $40,000, but you don't cut your expenses. Instead of making 25, you make 15. And you think, well, then the heck with them, I want to cut my prices. So your sales go back up, but your margins are lower because your cost of goods went from 50% to 70%. You didn't cut your expenses. And so you, instead of making 25,000 or 15,000, you made 5,000, but you were really, really busy because you did a whole bunch more work at less margin. And then you think, now I'm so tired, I need to hire a helper. So your sales with a helper, they went up some, but you increased your staffing. And so now instead of making 25 or 15, you're back at 5 because your salesperson, your helper, did not help you increase your sales enough to pay for themselves. So that's a 4-year cycle. If you want to look at it, that's 4 different businesses that come in and see me, have those kinds of profit and loss statements that we're trying to help them work through. Now, specifically, now we're going to look at some COVID-19 examples, and we're going to look at it month to month because that is the time frame that many of us are working on right now. We can't even look at years; we have to look at months. Okay, so a normal month pre-COVID-19, we sold 20,000. We had 10,000 in cost of goods sold. Now I just put 50% on there. It's that vary for cost of goods sold. That varies from industry to industry and business to business. Yours may be 30, it may be 70, but you should know what it is. And you should have an understanding of whether that fits with the industry or whether you're high or low. We actually have industry standards on what the cost of goods sold should be. Early, if you remember back to our Johnny Carinos, I was estimating that their food cost was 30%. Restaurants are usually 40 to 45. So I was just doing on the low end. But that cost of goods sold, don't get hung up on it with being 50% because that could be high or low for your industry. You need to figure out what that is, which basically means you may need to cost out your menu and kind of figure out in a $5 breakfast, how much do I have in it? $2. In a $10,000 fire job, how much do I have in it? $4,000, $8,000, whatever that number is. You need to know that number for your own business. That being said, in a normal month, this is what we're looking for: $20,000, 5,000 at the end. 5,000 times 12 is $60,000 a year, and that's not a bad business. But COVID hit, and now we are having a gotta get them through the door month. They open up the economy on May the 1st or the 12th or June or whatever, and I do whatever I can do to get everybody through the door. My sales are still down from 20 to 16, but because I coupon and I BOGO'd and I begged people to come in, my margins went up, my profit went down, my gross profit went down rather. Now, in a positive note, I got the PPP, so I don't have any staffing costs. And so I made $2,000. If I wouldn't have gotten the PPP and my normal $3,000 of staffing was right here, I would have lost $1,000. So this is the trying to get everybody through by giving everything away approach. And if $2,000 is better than zero, so if you can make this work, then maybe that's an option for you. This is the employees get paid, but I go broke month, right? So I didn't get PPP. My sales are cut almost over half. I maintain my margins, but because I keep my people working, I have $1,000 loss, right? And so that might be something that people have to choose. You can do that for 12 months. You keep your employees, you lose $12,000 for the year, you take it out of your savings and you survive and go forward. And that may be what people have to do from that perspective. This is the hard choices month. Revenue is still down, margin is still good. I didn't get PPP, so I had to leave some people on unemployment. So my staffing is $1,000 instead of the normal 3,000. But I made $1,000 and I can survive for a while doing this. This is everybody working hard that's still working. I do a lot of the work myself. I didn't get a PPP, so I'm just struggling by, but this is a choice some people might have to make. Sean, I'll pause for a minute. Any questions?
Yes, we do. If regarding the labor situation again, someone asked, is it possible that someone could be both labor cog and expense? And if
Yes.
so,
Yeah. So in a small business, a lot of times you'll see that where somebody works in the shop in the morning and they work in the office in the afternoon. And so what we normally do is we include them in the cost of goods sold for the direct labor part of what they're doing. So if they go out and they weld or they box or they sand or they do whatever in the morning, or they provide services or whatever in the morning, they clean carpet in the morning, they work in the office in the afternoon, then part of their money would go to direct to cost of goods sold, and then I would put if they make $30,000, I put 15,000 in their administrative part. If you
Okay.
put it all in the below, if you put it all their whole income in the cost of goods sold, that overstates what your cost of goods sold is, and it makes your margins look worse when they're really not that bad. If you
Gotcha.
put them all in the administrative, then that makes your margins look better than they actually are because you're getting free labor and the office is being charged for work that kind of not being done because they're spending half their day in the shop. So you should work with your accountant to get it kind of going in both directions. But yeah, so um, even if you don't write it on their paycheck like that, which will be harder to do, you at least have to have an understanding that we pay Joe $30,000, but half goes to direct labor, half comes from direct labor, and half comes from the office.
Gotcha. Thanks. Thank you.
Okay. So we just did the hard choices month. Now we're going to do the really hard choices month. Revenue is still down. I still didn't get my PPP. I did a good job of maintaining my margins. So I have not cut my prices and everything, but I'm having extra operating expenses due to COVID-19. I'm wiping everything down. I got PPP. I got PPE, all that personal protection equipment, all that, and it's just costing me more than it's supposed to be. So now I got to figure out what I'm going to do here because I'm keeping people on, which is good for me, but it's costing me $2,000 a month in loss to do that. And so I got to figure out how do I we have a lot of conversation when people are starting up about what is the right scale of the business. Should you start out as a hot dog cart? Should you go as a kiosk? Should you be a carry-out restaurant, a bigger restaurant? And so when you have already been in business, you've kind of already determined what your scale should be. Now that everybody's been shut down, having a little mini version of the scale conversation again is trying to figure out how do I scale back up again? Do I bring back all my employees to office, to shop? How do I do that where I can actually make enough money to stay open or do whatever I want to do, to achieve your goals, whatever? If you have great employees and you don't want to lose them, you may want to take a $2,000 loss a month because you don't want to lose your employees. If that's not the case, or if you don't have enough money in the bank to survive that, then you got to figure out, what do I have to do? What's the right scale for me coming back that I can stay open? And so we're going to talk about how to do that right now. And I would say work backwards to figure it out. And so work backwards is basically just taking your profit and loss statement and starting at the bottom instead of the top. Figure out what you need to make. And so you may have to talk to your accountant or your projection to figure out what net profit do I have to make to give me enough to take home what I have to take home, because $5,000 in net profit is not $5,000 going into your pocket. That's pre-tax. You got to figure that out. But the first thing is, I know that for me to survive as the owner, to run my household or whatever, I need 5,000, 10,000, 2,000, 4,000, whatever that number is. So I'm going to start at the bottom. You see the arrow is green because green is good. That means money. And we're going to see red arrows here in a minute, which red is bad, which means giving it to somebody else. Okay. So we're going to start at the bottom, $5,000, what I need to make. Then I got to add in my fixed expenses. And I know these pretty much. I know that my light bill, my insurance, my workman's comp, my rent, my whatever else I pay, I know what those are for the most part. There's a note in there about advertising. People might say, well, if advertising is not fixed, I cannot run my ads. I cannot buy that billboard. I cannot do whatever. I would agree that it's not fixed, but if it's necessary to run your business and to make your goals, then it might as well be fixed. And if you cut your advertising, if you cut your advertising and you should see a drop in your sales. If you don't see a drop in your sales, you shouldn't be doing that advertising. So don't cut. This is not a time to cut your advertising, but it may be the right time to right size it based on what's going on. So we took our net profit, we added in our fixed expenses. That tells us what our gross profit has to be. I have to have $10,000 to pay $5,000 of expenses and have $5,000 left over. And gross margin is the percentage of the sale that is profit. Gross profit is the amount of money that's left over. So don't get those two things confused. The gross profit is the percentage that you apply. I'm sorry, the gross margin is the percentage you apply. The gross profit is the dollar amount that it actually is. All right. So we know we have to have $10,000. So when I said earlier, that's the top number that we have to cover the bottom number. That's what I'm talking about. That's the number of gross profit that you have to have. And if that number is $2,000, there's only so much you can do squeezing your expenses to get down to another number, but it will never be more than 2,000 because that's the top number. That's the highest number that it can be. So if it's 2,000 and I have 0 in expenses, I'm still only going to make 2,000. If my net profit needs to be 5,000, I can't get 5,000 out of 2,000. Okay. We add in then the cost of goods sold, and that's in as a percentage, which then tells us what was going to come out of that percentage. And so, as it says on the side, your estimate will not be perfect. It will be a goal. People want to argue all the time. I don't know what it is. I don't know how to put that in there. You got to sit down and figure out what it is. If you're going to put on a room addition, you have to know it's this much labor and this much wood and this much whatever to figure out what you should bid on that. And if you don't, you're just flying blind and guessing. And hopefully you're guessing right, but in the long term, the market will tell you whether you're guessing right or wrong. So even if you don't know it, it's a guess, and then you got to turn around and start tracking it to understand if you were accurate or not. If you don't know, you should know. Cost out your menu. If you're an insurance agent, they really don't have a lot of cost of goods sold. So they're going to be able to skip this line item really, unless he checks in and tells me that he does, because they don't have a lot of consumables. They don't have ingredients in their sandwich. They are getting fees. So all their expenses would be like all their labor and everything would be in the expense section. But for somebody who is building something, doing something, creating something, providing a service, they're going to have some kind of cost of goods sold to do that. And as I said earlier, it may vary from product to product or service to service. John Mantor is not going to get rich cleaning carpet because when he charges you, it's only $75 or $150 or $300, whatever to start with, and then he has to pay someone to jump in the truck and go out there and do that. And so, there's only $75 only goes so far. But if he's doing your $10,000 kitchen or a $20,000 basement cleanup, he has to understand if that's costing him $5,000, $10,000, or $20,000 because he has to know what to bid it. Okay. Our last number then is calculate the sales you need to make it to hit your numbers. And so you have to, if you know that, let's back up for a minute. If I know that I need $10,000 in gross profit to cover my bills and have some left over, and I know that I get 50% on what I sell, then this top sales number is just a math number. I got to have $20,000 here to take $10,000 out of it to have $10,000 left. If my cost of goods is higher, I have to have a higher number up here. If it's lower, I can have a lower number up here. So in this situation, it has to be 20 to take 10 away from it so that I can have 10 left to pay all my bills and have 5,000 left. So in this 20, you take your make sure you take your product mix into account and figure out at $20,000, I got 5 categories of what I sell. Where's it going to come from? Is it going to come from right now? If you are an HVAC company, it may be coming from anything that you can do outside. But going inside somebody's house may not have any money coming in from that. So you may have to calculate based on what services are available to you in this situation. And so just be aware of where you think the money is going to come from, as opposed to just being a magical unicorn number that $20,000 is going to come in from somewhere. I don't know where it's going to come from. Once again, the estimate's not going to be perfect. It's going to be a goal. I'm trying to hit $20,000 from these 5 categories. They're all going to bring in $4,000 a piece, or one's going to bring in $10,000. All the rest are going to be the balance, or whatever that looks like. And so you have to smell test your numbers. Does it make sense that if I say that if I'm a restaurant and I say that all of my business right now is going to come from sit down, inside, breakfast? And the answer to that is that smells funny. Then no, that's not going to happen. Is it reasonable that it's going to come from some from carry out and some from delivery? Yes. If they open up somewhat, then I'm going to get 40% of my revenue from inside sit down business, because I can't have a full restaurant, and I have to turn around and balance that with carry out and delivery. So do your numbers smell right? And then can you hit the numbers? And can you hit them with the advertising that you have allocated? If you said, I got to hit more money than I've ever had monthly, and I'm not going to put any additional advertising into that, I'm just going to hope for the best. That doesn't smell right. That's not going to work. Okay. So I'm going to stop for a minute there, Sean, see what kind of questions people have, and then make a transition and then be done.
All right. Anybody have any questions for Scott? Currently, Scott, we do not have any questions in the queue for you.
Okay.
There has been a great appreciation so far for what you have shared, so we really appreciate that.
It's weird. I have a new thank you. I have appreciation for my pastor now, who is preaching to nobody. This is not fun or easy, and it's kind of weird, but okay. So this is a quick note about markup and margin. And markup and margin, people use those two terms interchangeably, but they're not the same. And so all of our calculations that we've been doing on the previous pages, we're using margin and not markup. And so if I'll show you here in a minute, but when I talk to people, they say I mark up my stuff 40%, so I'm making 40% on them. And that's not accurate, and it's not, but it's very, very common. And so a lot of people have a table like what I'm getting ready to show you to try to make sure that they're doing things properly. And I would say that people like to argue with this, but then you do the math, and then they still like to argue, but I can't help it, it's the math. If I want to get a 41% margin, that's what I need to make my numbers work. That's what I need for gross margin to pay all my bills and make my numbers work. I got to mark up my products or services 1.7. If I know that I have to get 50% on a margin to make my numbers work, then I got to mark stuff up 2 times or double it, right? So let's just take this. If something costs me 100 and I double it, I get to 200. I had $100 in a $200 sale. That's 50% cost of goods sold, 50% margin. If you'd have marked it up 1.5, like people do, they end up with $100. They mark it up 1.5 to 150, and then $100 of cost and $150 in sales is a 66% cost of goods sold, or a 33% margin. Whoops. And so what happens is they say, I'm getting 50% margin, but they're only marking it up 1.5. And at the end of the year, they don't have the money that they think they should have because they've not done this properly. So I'm going to give you the case of the missing money, and then we're going to be done. An auto parts shop buys parts for $100. And because he's done a good job, he knows he needs 41.2% margins to meet his financial goals. He's done his projections. He knows that's what it takes to pay his expenses and still have something left over. But he makes a mistake and he marks them up 1.42 to meet his goals. He sells the parts and he sells it for $142. He gets a profit of $42. He puts it in the bank and he goes about his day being happy. But then he goes to pay his bills, and he has $70 of bills like he thought he was going to have, but he only has $42 in the bank. If he needed to have a 41.2% margin, he should have marked it up 1.7, which he would have had $170, which would have had $70 left over, and he had enough to pay his bills. And so what he does is he does it over and over and over, and he rinses and repeats until he goes out of business, because he doesn't realize that his markup is not giving him the margin that he needs to make his numbers. So he either goes out of business or he calls us and we help him figure it out. So here's what we do, in case you don't know. We are free. We're paid for by your tax dollars. They don't like for us to call it free, but it's no cost or obligation except for your time. We do consulting. We help with financials and projections. We do demographics and industry reports, help you connect with the right people. We know lending programs and bankers and that kind of thing. And then we can do other stuff a la carte. I am done. What questions do you have?
Thank you, Scott. We appreciate that. And I think you did answer a question. One question was, do you meet with and advise small business owners on these matters? And with that last projection slide there, I would think you would say, sure.
Normally in person, right now, phone or WebEx. But if we're going to do financial projections, it works great on the WebEx on a screen share. Works as well, if not better, than being in person. So absolutely.
Okay. Excellent. I wanted to open up for the call-in users. The call-in users don't have access to typing in a question. So if any of our call-in listeners have a question, feel free, unmute yourself, and I will recognize you and you can speak. So feel free. We'll give you a few seconds here. Just to let everyone know, this webinar has been recorded and it will be available on the Chamber website under our video library page. So feel free to go to that link and you can download it. You can do with it what you please. It will be a YouTube link. So, and then Scott, it would probably be the easiest is if you would email me the slides to this, and I will put that with our video link on our website.
I wasn't listening to what you said, but I will do whatever you ask.
Outstanding. Thank you, Scott. Really appreciate that. It looks like everyone, no one else has any questions for you, Scott. I do know that everyone has been grateful and has really enjoyed your presentation. And I've been getting a lot of those types of comments thanking you for that. So we really appreciate that. Just a reminder to everyone, there is a webinar regarding Not So Fast. It is in today's newspaper, that conversation. It is on Tuesday, April 28th at 2 p.m. To register, you need to go to the EDC website. And on there will be a link to register for that webinar. So if you have any questions, though, with that, feel free to either email the EDC or myself, and we will try to work that with you. Thank you again, Scott. We really appreciate it, and we will end our meeting. Thank you so much, guys.